Despite the recent tariff-related stock market correction, investors have actually done quite well in recent years. The S&P 500 and Nasdaq may both be around 10% off all-time historic highs, but long-term buy-and-hold investors who bought in 5 years ago would still have more than doubled their money. You see, even though it may seem hard to believe, investors are optimistic. Just as past booms were fueled by transformative technologies, today's strong valuations are built on the belief that AI will reshape the global economy. Investors are pouring money into tech giants and startups alike, betting that AI will deliver unprecedented productivity gains and open up entirely new industries, much like the transformative technologies of the past. However, the prolonged rise in asset prices began well before the recent development of AI and has been supported by a broader environment of global stability and the steady 45-year decline in interest rates. You see, falling interest rates play a crucial role in boosting asset prices because they lower the cost of borrowing, encourage businesses to invest, and encourage consumers to spend. They also increase the present value of future corporate earnings and cash flows when discounted back to today, making stocks, especially those promising high future growth, appear more valuable. For example, imagine you have a bond that pays $10 a year into perpetuity. That means it will pay $10 every year from this year to the end of time. If long-term interest rates are 10%, then the value of that bond is $100, because the coupon of $10 is 10% of $100. But imagine that long-term interest rates suddenly reduce to 5%. Well then, the value of this bond increases to $200. It will literally double. How can that be if nothing has changed and it still pays $10 a year? Well, something has changed. Interest rates have fallen to 5%, and $10 is 5% of 200. In exactly the same way, the valuation of stocks has increased over recent decades as interest rates have fallen. This rise in stocks has quickly filtered through to other asset classes, including bonds, commercial real estate, housing, emerging markets, private equity, and others, as investors seek out any investment they can find that yields a decent return. Okay, this naturally raises the question, what has allowed interest rates to fall so far for so long? Well, the steady decline in interest rates over the past 50 years didn't happen by accident. You see, it was made possible because inflation also kept falling, and that in turn came from two major changes. First, countries around the world gave their central banks more independence, especially after the chaos of the 1970s and early 1980s. Without politicians interfering every election cycle, central banks could focus on just one job, keeping inflation under control. Over time, they built up real credibility, and people started to believe that inflation would stay low, which made it easier to actually keep it low. And second, with globalization, the world opened up for business like never before. Factories moved overseas, supply chains stretched around the world, and goods became cheaper to produce and ship. With global competition keeping costs down, companies couldn't easily pass price increases onto consumers, which helped keep inflation in check. Together, stronger monetary policy and globalization created a perfect environment where interest rates could drop lower and lower without sparking a new inflationary spiral. And that steady drop has been a huge boost for asset prices ever since. However, while the boom in asset prices has been impressive, there are growing signs that valuations may have run too far ahead of reality. By many measures, optimism today is reaching levels that are almost unprecedented. Take stocks, for example, the Shiller CAPE ratio, which looks at prices relative to the average of 10 years of earnings. This ratio is currently hovering around its highest levels outside of the dot-com bubble. In housing, it's a similar story. The US Shiller Home Price Index shows that house prices relative to incomes are near record highs, well above their peaks during the 2006 housing bubble. Even broader measures like the Buffett Indicator, which compares the total stock market value to GDP, suggest the market is extremely stretched. In short, whether you look at stocks, real estate, or other assets, prices today are priced for perfection. But as with the 19th century railway bubble and 1920s Wall Street crash, history reminds us that when optimism gets too far ahead of underlying fundamentals, corrections often follow. Exactly when a potential correction could happen is impossible to predict. Even legendary Federal Reserve Chairman Alan Greenspan famously warned about irrational exuberance in the stock market back in December 1996. But it took nearly 4 more years before the dot-com bubble finally burst. Timing these things is notoriously difficult because optimism can sustain itself far longer than anyone expects. However, if you're looking for a catalyst, some event that could shake the foundations of today's optimism, global stability, central bank independence, and globalization itself, one major candidate stands out: the election of Donald Trump. His presidency has already brought major disruptions to global trade relationships, questioned long-standing alliances, and increased pressure on central banks to act in politically motivated ways. In other words, the very forces that have supported falling inflation and rising asset prices for decades are beginning to crumble. Whether this leads to an immediate crash or a slower unraveling is impossible to say. But one thing is clear: with the foundations of the boom under strain, the risk that the stock market bubble could pop has never been more real. A link for the next video should be on your screens now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.